Hello students, today we are going to discuss about the paper solution of the subject elements of direct taxes, 30 marks, 30 MCQ, and this is a set A. So let's begin the video. So to find out the correct answer, a resident HUF is said to be ordinarily resident in India. So here two words are important. Here already we are assuming that HUF is resident. That means he has satisfied one of the basic condition, or that his control and management is partly situated in India or wholly situated in India. So that is why he becomes a resident in India. So now to become ROR, he has to satisfy both the additional condition. So which option gives you the correct answer? So here two answer are very similar. If HUF satisfy both the additional condition, if Karta of HUF satisfy both the additional condition, these are two near options. In that, whenever HUF satisfied basic condition, we have to focus on Karta only. So if Karta of HUF satisfy both the additional condition, then only he becomes ROR, resident and ordinarily resident. So answer for this question is D. Now, a foreign company is said to be resident in India only if the company conduct business in India, place of effective management in India, manufactures in India, and place of effective management outside India. So, a foreign company is said to be resident in India only if the place of effective management is in India. This is the answer. Place of effective management should be in India. Then only it is considered as Indian company. So, B is the answer. Now, next one. Mr. Adi is a resident but not ordinarily resident. That means his status is RNOR in India, having interest income from deposit in USA. That means it is a deposit income of 3 lakh. One third is received in India. Then how much amount is taxable? So it is a foreign income or Indian income. So here there are two bifurcation for 3 lakh. 3 lakh into 1 upon 3 and 3 lakh into 2 upon 3. So 1 lakh is Indian income and 2 lakh is foreign income. So this 1 lakh is taxable in case of all the category, whether RA, ROR, RNOR or NR. And this foreign income is taxable only in case of ROR. And here the status of a Mr. Adi is RNOR. So that means it is a Indian income. That is why it is taxable in the hands of Mr. Adi. If he is a RNOR, amount is only 1 lakh. So C will become your answer because his status is RNOR. Now next one, Mr. Manish is resident and ordinarily resident in India in previous year 2021-22. So that is the status of ROR, and having remittance of profit from his business in Dhaka, Bangladesh of rupees 5 lakh of past financial year, then how much amount will be taxable? Here you should understand a remittance of profit is not taxable at all because it is an income of the past year, and past year income brought in the current year, it is called remittance. So that is why nothing will be taxable in case of remittance of income. So fourth answer is D. Now next one, residential status of Mr. Krisiu for the previous year 2021-22 is resident but not ordinarily resident in India. That is status is RNOR. He has earned rupees 3 lakh 80,000 for the business situated at USA being controlled from India. The whole amount from business is received by Mr. Krisiu in USA. What will be the taxable amount in the hands of Mr. Krisiu? Here you have to identify the nature of income. This 3 lakh 80,000 is Indian income or foreign income. So according to the situation, it is a foreign income. Why? Because he has earned income in USA and he has also received the income in USA. So that is why it is a foreign income. And so that is why now we have to see what is the control of the business, where control of the business is located. If control of the business is located in India, then it is taxable in case of ROR also and in case of RNOR also. So here situated in USA but being controlled from India. So whole business is controlled from India. So that is why even though it is a foreign income, it is taxable in case of RNOR also. So and status of resident but not ordinary resident in India is given. So that is why it is taxable in the hands of Mr. Krisiv. So in that case, 3,80,000 is the answer. Reason is very simple. Normally, foreign income is not taxable in the hands of RNOR, but only there are two exceptions to this rule. If profession is set up in India and if business is controlled from India, then even though it is a foreign income, then also it is taxable in the hands of RNOR. Now, next one, which of the following statements are incorrect? So here focus the word incorrect. We are focusing on or we are finding out the incorrect answer in respect of the first previous year for the newly set up business or a profession. So three sentences are correct, one sentence is wrong. So you have to write down the incorrect one. The period beginning from the date of the setting up of the business and ending on the last day of that financial year, that is 31st March. So this is the correct year because whenever you start the business on the starting date, it will become your start date and obviously it end on 31st March of the that year. It can never exceed a period of 12 months. Yes, it is also correct answer because previous year, first previous year or any previous year, total duration of previous year is not more than 12 months. Then next one, see, it can be less than 12 months. So it is also possible because first previous year is also less than 12 months. It will always starts from 1st April and ends on 31st March. So this is the wrong answer because it is not necessary that every time previous year starts from 1st April, because if you start business in between, like if you have started business on 1st October, then what is your previous year in that case? 1st October to 31st March. So that is why this statement is wrong. So your answer for 6 is D. So this will become your answer. Now next one, which of the following are or is person as per section 2 subsection 31 of the Income Tax Act 1961. So LLP is also a person. It is because it is one type of partnership form. AOP and BOI also person. It is included in the definition of person. LLP is not directly given in the meaning of person, but partnership form is given. Form is also a one type of person, and LLP is also limited liability partnership form is a one type of partnership form. So that is also considered as a person. So A and B both are your answer, and that is why in this case C will become your answer. So answer for this question is C. Now next one, which of the following income is not taxable in the same year in which it is earned? So in that you have to find out the incorrect option. Income of the person living India for a longer period. That means for that person also it is taxable in the same year in which it is taxed on. Income of the body form for shorter duration. It is also case of exception. Income from the discontinued business. Also it is a case of exception. Only income from salary is taxable is not taxable in the year in the same year in which it is earned. So most appropriate answer in this case is D. Otherwise these all three are exceptions to the previous year. So that is why they will not become the answer. Only income from salary will become your answer in case of option number 8. Now next one, any person who does not deduct a tax at source or after deducting tax fail to pay deducted tax to the government is called assessee in default. This is a simple one because he has make one default. So that is why he is known as assessee in default. So C will become your answer. Now next one, which of the following is not considered as income under the provisions of Income Tax Act 1961? Salary is a income, rent is also income, award received by professional sportsman is also income. Pin money is not considered as your income. So that is why here D will become your answer. Now next one, Mr. Amit has received scholarship of 90,000 during previous year 2021-22 to meet the cost of education. However, he spends only 50,000 towards the education. Calculate the taxable amount of educational scholarship. So here answer is, in case of D is nil, because if you have received educational scholarship for the education, so whatever amount you have received, that is totally exempt. So that is why nothing is taxable. So answer is nil in this case. So D will become your answer. Mr. Ali's received rent of rupees 30,000 per month during the previous year 2021-22 from the land which is situated in India and is used for the agricultural purpose. Suggest the correct treatment with reference to Income Tax Act 1961. This is the point of exempted income, in which we had discussed first section 10 subsection 1, agricultural income in India. So that means what? Here 30,000 per month he is receiving 21-22 from the land which is situated in India and is used for agricultural purpose also. So in that case, whole income, whatever he is generating from it, it is fully exempt under section 10 subsection 1. So it is a point of exempted income. Now next one, which of the following income is partly taxable? So here, which one is the partly taxable? Payments received from family income by a family member of the HUF, it is totally exempt because to avoid double taxation. Share of profit from a partnership firm, it is also not taxable to avoid double taxation because partnership firm has already paid tax on the income, so it is not taxable in the hands of partner. Commutable pension received by employee, now this is partly taxable, so that is why in this case answer C will become your answer. But daily allowance by of member of parliament, this is also totally exempt from tax. So this is also MCQ from exempted income. So daily allowance of the member of parliament is also exempt. So most appropriate answer is C. Now A is a minor son of Mr. X. A receive interest on deposit 500 per month. So now total amount received by son is 6,000. Now find out the income that would be accessible to tax in the hands of Mr. X in respect of the income of his minor child. So minor child has earned 6,000, but there is a one provision in exempted income. Whatever income he has received, that is taxable in the hands of Mr. X because he is a representative assessee. Mr. X is a representative assessee of A. So that is why he will get exemption of rupees 1,500. Fixed exemption is available. So now what is left now? 4,500. So this 4,500 will be added into the income of Mr. X. So that is why what answer will become 4,500. So that is why what is the question? Find out the amount of income that would be accessible to tax in the hands of Mr. X in respect of the income of his minor child. So minor child income is 6,000, but out of 6,000, 1,500 exemption is available. So 4,500 will become the answer. Now next one, Mr. A is a partner in a partnership firm named A, B and Corporation, and he has received a share of profit of rupees 3,80,000 from the partnership firm. What will be the taxability of such profit in the hands of Mr. A? Now in this case, D will become your answer because 3,80,000 will be exempt from tax to avoid the double taxation because it is 3,80,000 is received from a partnership firm to Mr. A and Mr. A is also partner. So 3,80,000 is totally exempt in the hands of Mr. A because partnership firm has already paid a tax on it. So that is why 3,80,000 will be exempt from tax in the hands of Mr. A. Now, Mr. Ram is working in Abhay Limited and receives 15,000 as a uniform allowance. So, 15,000 as a uniform allowance and 3,000 as a conveyance allowance. Now, his actual expenditure from uniform allowance is 9,000 and actual expenditure in case of conveyance allowance is 1,000. And this is a case of allowances in which how much you spend and how much you have received. Whichever is lower will become your exemption. So 15,000 and 9,000. What is your exemption amount? 9,000. 3,000 you have received for uniform conveyance allowance, and how much you have spent? 1,000. So that will become your exemption. So now what is taxable amount? So taxable amount is 15,000 minus 9,000. So in case of uniform allowance, 6,000 is taxable. In case of conveyance allowance, 2,000 is taxable. So what is now total taxable amount is 8,000. So in this case, C will become your answer. Now next one, Mr. X, who resides in Chennai, gets rupees 3 lakh per annum as a basic salary. He receives 50,000 per annum as a house rent allowance. Paid by him for the rental accommodation occupied by him is rupees 40,000. Find out the amount of taxable house rent allowance for Mr. X for the assessment year 2022-23. So in this case, 17, A will become your answer. How? Let us find out. There are three steps. Now Chennai is a metro city. That means you have to take 50% of salary. So what is your 50% of salary? So your salary is 3 lakh, and DA is not given, commission is not given. So directly we will take 50% of 3 lakh. So 1 lakh 50,000 is the first step answer. Second one, amount of HRA received. How much HRA they have received per annum? 50,000 per annum as a house rent allowance. So 50,000 is HRA received. Now third one, rent paid minus 10% of salary. So rent paid is 40,000 and 10% of salary is 30,000. So what is left now? 10,000 is left. So now 1 lakh 50,000, 50,000 and 10,000. The lowest amount will become exemption. So 10,000 will become your exemption. But here we have to find out how much is taxable. So that means how much you have received? 50,000. Out of which 10,000 is exempt from tax. So now what is taxable? 40,000 is taxable. So this way 40,000 will become your answer. Now next one, X receives 18,250 per month as a pension from the central government during the previous year 2021-22. What is the amount of pension taxable for the assessment year 22-23 on the assumption that it becomes due on the last day of each month? So here it is a case of uncommutable pension. An uncommuted pension is taxable for all the employee, whether he is a government employee or non-government employee, private employee, whatever. So that is why what you have to do here, you have to straightway multiply 18,250 multiply by 12. So you will get 2 lakh 19,000 as your answer. So that B will become your answer in case of question number 18. Now next one, the central government has been empowered by the entry dash of the union list of Schedule 7 of the Constitution of India to levy tax on income other than agricultural income. So here answer is 82. So entry number 82 empowers central government to levy taxes on the income of the person other than agricultural income, because agricultural income is comes under the purview of the state government. It is not the matter covered under the union list. So that is why here answer is 82, entry number 82. Income tax is dash in nature. So income tax is progressive in nature, regressive in nature, steady or inflationary. So answer is income tax is progressive. Why it is a progressive? Because it will make a differentiation, discrimination on the rich and poor, because it will take high amount of tax from the rich people and low amount of tax from the poor people. So that is why it is known as progressive in nature, whereas indirect tax is regressive in nature. So in case of 20, A will become your answer. Now 21, standard deduction from salary is allowed to dash. It is allowed to standard deduction, government employee, private sector employee, PSU, all types of employee standard deduction of 50,000 is available, maximum 50,000. What will be the amount of standard deduction if gross salary here of rupees Mr. X is rupees 45,000? Here amount of standard deduction is 50,000. Maximum amount is 50,000 and his gross salary is 45,000. Now whichever is lower, that will become his exemption. So here 45,000 will become the answer because 45,000 is the lower one than the 50,000. The next one, what is the maximum amount allowed as a standard deduction to the employee? So maximum amount of rupees 50,000 is allowed as a deduction in case of standard deduction. Deduction of entertainment allowance is available to the dash. It is available only to the government employee. Other than government employee, no one will get the deduction of entertainment allowance. Now next one, calculate the amount of deduction of entertainment allowance if actual entertainment allowance is 6,000 and basic salary is 40,000. So here you have to find out, make comparison of three amounts. Actual entertainment allowance received, then 20% of basic salary. So basic salary is 40,000, 20% of it is 8,000. Now, and there is a standard limit, statutory limit, and statutory limit is 5,000. Out of these three amount, the lowest amount will become your answer. So 5,000 is the lowest one. So that is your exempted amount. So deduction is of 5,000. So C will become your answer. Now next one, 26. For the valuation of rent-free accommodation, if the furniture is owned by the employer, the taxable value will be. So here, who is the owner of the furniture? Owner of the furniture is employer. So in that case, what is the taxable value? Taxable value is 10% of the cost of the furniture. So you have to make the 10% of the cost of the furniture. Now where the population size is less than or equal to 10 lakh, the valuation value for the purpose, it will be dash percentage of salary for the period during which the employee occupied the rent-free accommodation. Unfurnished accommodation is 7.5%. In case of 27, answer is 7.5% because there are three situations. If population is more than 25 lakh, then 15%. If population is 10 lakh, above 10 lakh but less than 25 lakh, then 10%. But if population is less than or equal to 10 lakh, then 7.5% of the salary will become the value of rent-free unfurnished accommodation. Now next one, X, an employee of the central government, receives 78,000 gratuity. He retires on December 12, 2021 after rendering service of 38 years and 8 months. At the time of retirement, his monthly basic salary and dearness allowance was 2,400 and 800 respectively. What is the amount of exempt amount of gratuity? So here, gratuity is received by central government employee. So if it is received by central government employee, then whole amount is exempt. Now no need to do any calculation. Directly you have to find out what is the total amount of exemption which is available to Mr. X. So here full 78,000 exemption is available. And what is taxable? Nothing will be taxable. But what is the question? How much is exempted amount? So that is why D will become your answer in this case. Now determination of residential status of Mr. X, a foreign citizen, reside in India during the previous year 21-22 for 65 days, whether he is able to satisfy any of the basic condition. So he is not able to satisfy first basic condition. That means he is not in India for more than 182 days or 182 days. But he is satisfying second basic condition. What is second condition? He must be he must be in India for 60 days or more during the previous year. So he is in India for 65 days and 365 days or more during 4 previous year immediately preceding the relevant previous year. So if you make total of 4 previous year, this is 1, this is 2, this is 3 and this is 4. So if you make this total of these 3 years, 4 years, you will get it is more than 365. That means he satisfied the second basic condition. Now that means he is a resident. Now whether you have to check whether ROR or RNOR. So in that case, you have to check additional condition. So in a first additional condition means what? He must be resident in India for at least 2 years out of 10 years. So here directly straight away you can say that in 1819 he is in India for 220 days, and in 1718 he is in India for 365 days. So he is resident in India for 2 years out of 10 years. So that means first additional condition is satisfied. Now second additional condition, he is in India for 730 days or more during 7 previous years immediately preceding the relevant previous year. So if you make total of this 1, 2, 3, 4, and 5, it is more than 730 days. So that is why he is also satisfied the second additional condition. So that is why his status is resident and ordinarily resident in India. Now, Mr. Manoj, an Indian citizen, left India for the first time for the purpose of getting employment outside India on 9th of October 2021 for the first time. He came to India on 21st March 2022. Determine the residential status of Mr. Manoj for the assessment year 2022-23. So he leaves India outside India for the job purpose. That means exception number 1 is applicable. So if he stays in India for more than 182 days, then only he will become the resident in India. 192 days plus he comes back in India on 31st March. In March also 10 days. So 202 days stays in India in the previous year. So that means what? He satisfies the first basic condition and both the additional condition. So his residential status is resident and ordinarily resident in India.